Andrew Holland is joining us right now to give us his perspective on the markets. Andrew, hi, welcome on board. Why are you cautious and defensive in the current market? We're looking at a good up move, especially this week has been quite cheery. Do you think going forward it may not sustain, given the fact that there's a lot of global uncertainty and the Lok Sabha elections?
So I think two things. One is that let's talk about the global factors, which is of concern. But globally, the markets are taking this as being good news for the time being, in that interest rates are more likely to stay where they are, if not fall, going forward. So the market is saying 6 months out we could see low, at least interest rates where they are, if not lower, and that's obviously good for equity markets. And that's flowing through to emerging markets, where we're seeing huge amounts of inflows. People are feeling a little bit more comfortable with China and what they're trying to do there. Of course, Brexit will continue to be a bit of a mess. So that kind of means that we're getting our flows because of emerging markets, and with expectations now running high that the BJP will could get through with a majority, has just kind of propelled our market higher. So lots of great things out there, which are keeping both global markets, and we're doing a bit of catch up as well. From other emerging markets. Say for China's up 22% so far this year.
Let's talk about the spaces, the themes that you are bullish on, despite the overarching volatile mood of the markets and the uncertainty that lies ahead. You seem to be constructive on domestic pharma and select IT names. Would that be from the blue chip basket, or are you also looking at mid-cap IT companies with respect to your bullish view on the entire space? And why the domestic phase pharma companies?
With pharma, it's difficult to get over the line with the kind of generics, the larger, kind of exporters, because, they seem to keep running into trouble with the regulators in the US. I think the margins in the US anyway are under huge amounts of pressure in the generic space. So I think those type of companies really still have to kind of re-engineer how they move forward, whereas the domestic side, you're still seeing good growth, and that's being shown in the share prices as well of those companies. So we're a little bit more domestic than we are kind of exporting side of pharma, and of course with the rupee appreciating a little bit so far in the past week or so, obviously that's a bit of a headwind for those pharma companies as well. So that's how we're looking at pharma. I think overall though, if I fast forward 6 months, which I tried to do last time I was here, was you could see a scenario where you'll see lower interest rates globally, and certainly in India, and if the slowdown is happening globally, then obviously lower commodity prices. So that lends itself to lower rates in India, and the RBI could easily do 50 basis points to my mind in April. So the banking sector is going to be a big beneficiary, and I think that's why you're seeing the outperformance of the banking sector.
You're fairly cautious on the auto space. Of course, I was just reading a brokerage note this morning that said that the down cycle, the downtrend for the autos looks like will be ending very soon going forward, and the stocks have already been corrected a fair bit. So it was a rather bullish stance from a medium to long term sort of a perspective. But you are cautious even in the longer term?
No, you see, things change and valuations become, more compelling, but they're certainly nowhere near compelling at the moment. Everywhere we go and we speak to companies involved, whether it's auto parts suppliers or the auto makers themselves, they're sitting on huge amounts of inventory. And when you say, okay, listen, isn't the MBFC problem, is that cause you problems, is that where it's coming from? And to some extent, no, because a lot of them had their own financing anyway. Right, so it's not been the MBSC problem. It's more to do with the change in insurance that You know, people have to pay up for more 5 years now. So I think that's been a dampener. But listen, what it is very simple. The growth that they've enjoyed over the past 5 years or so is not going to be as strong. It's going to be single digit. And when you get single digit with high inventories, then you're going to have to start doing something. And you're usually going to say, I need to advertise more, I need to discount more. And when that happens, it hits your margins very hard. And that's all that's going to happen in the auto sector. So the analysts, you know, when they finally get down to the bottom of the forecast is probably when they'll say it's a better buy. At the moment, their valuations are too high because their profit forecasts are too high. So I don't see why it's a bottom yet. So it's a structural sell at the moment. It might be more compelling going down the road.
Okay, Andrew, always great chatting with you, and always good to get some insights from you on the market scenario and the themes and the sectors to watch out for.